It's the dominant theme in global macro and markets. But how has the breakdown of U.S.-Chinese relations changed since Donald Trump returned to office? Join our economists this fall for in-person briefings on global economic fracturing under Trump. We look forward to seeing you in Hong Kong, Singapore, New York, and London for a deep dive into the market risks and strategic challenges ahead. Sign up at capitaleconomics.com/events to join the conversation.
It's Friday, the 22nd of August, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, the great global jobs slowdown. How bad is it, and what will central banks do about it? But first, Neil is out this week, but I'm happy to say I'm joined by Leah Fahy, an economist on our China desk. Hi, Leah.
Hi, David.
Neil and I were talking last week about that slab of July data out of China, so industrial production, investment, retail sales. The broad message was that the economy isn't in great shape and the government needs to do more. But what? Near term, maybe a bit more fiscal spending, but longer term, it does come down to this need to rebalance, to bring down investment's role in the economy and boost consumption, including getting more money directly to households. I think that's probably a consensus at this point that is the prescription, but not much has been happening on that front. But what Neil and I didn't get time to get into last week were all of these announcements or reports of programs that are coming out of the government, that's been coming out of the government in recent weeks, that do suggest something meaningful might be happening. Or is it? So, Leah, to start, just give us a quick sense of what we think the government is doing here.
Yeah, so, this has started to be a key kind of priority that the government has been saying over the past year or so, particularly starting with this year's kind of National People's Congress. They've been reiterating the fact that boosting consumption is really important. They've got to drive up domestic demand. And so far, what we've been failing to see is any sort of meaningful follow through on that front. Well, that is until kind of the past month or so. We've had this slew of different announcements coming out of new government policies that look like they might actually just be starting to tackle the issues we've been flagging for some time. Just quick run through of what's been announced. We've had announcement of childcare subsidies for every child for the first 3 years of their life. The last year of preschool is going to be made free nationwide starting this school year, with the aim of that being expanded to all years of preschool by, I think, the early 2030s. There's some new subsidies for elderly citizens with disabilities that have been announced. And then most recently, we've had this announcement of this interest subsidy scheme for consumer loans. So essentially, the government is going to subsidize 1 percentage point of the interest rate specifically on loans that households use for consumption purposes. And again, this is all with the aim of boosting consumption, also clearly with the childcare parts, an aim to boost fertility rates as well, but essentially just leaving households with more money in their pockets, with the aim that they'll end up spending more and helping to kind of move towards rebalancing the economy.
So paying households to have more kids, reducing the cost of loans for households to go and buy stuff, to spend money on goods, but also services as well. In totality, is this meaningful? How much money are we talking about here? And what's the economic impact of all of this?
Yeah, so that's the thing. I think the logic behind these seem great, but when you break it down kind of policy by policy, the amount of money that's going into it isn't that significant. And I think the actual boost to demand to GDP isn't going to be that great. So, for example, with the childcare subsidies, the annual amount is only equivalent to around 1 week of the average family's income. So it's unlikely to have any significant effect on family planning decisions, but it might boost up consumption at the margin. Even then, if all of the subsidies are fully spent, then I think the total boost to consumption would be in the region of less than 0.1% of GDP. It's kind of a similar story on the kindergarten front. And then when we're looking at the loan subsidy scheme, it's quite hard to judge the impact that kind of thing will have. Rate cuts have varying impacts on loan demand depending on kind of the economic backdrop. But what we've recently seen in China is that bank lending rates have fallen by around a similar amount over the past couple of years. And we've actually still seen household loan demand continue to slow. So we're not that optimistic that this policy will boost credit demand. Obviously, there's kind of the additional boost to consumption that could come from that incremental saving on interest costs from households. But even then, again, it's kind of a similar story to the childcare subsidies. Even if all of the additional interest costs that are saved are then spent, I think that would amount to around 0.03% of total retail sales expenditure in 2024. So the upshot being, altogether, it's not that much. Even when you bring all these policies together, I think the boost to GDP to consumption will be pretty minor. But I think there's also a risk of kind of dismissing each of these policies individually, because they're not going to have a massive impact on growth, but then kind of missing the bigger picture, which is that the government is starting to prioritize these policies that we have been saying are quite important for some time. And as we see these policies incrementally stack up, eventually the impact could be a bit more significant.
That's key, isn't it? I want to get onto that. But before we do, doesn't sound, as you say, like it's going to have a tremendous impact near term. So just give us a sense of where we think the economy is heading out of 2025 and into 2026.
Yeah, we don't have a very positive view on what's been going on so far and the outlook going forward either. So obviously we look at things mostly based on our China activity proxy, which is our in-house alternative to official GDP figures. And on that measure, we've already seen kind of growth coming in below 4% for most of this year. And we expect a slowdown over the rest of the year. The key reason for that is obviously we've had these external headwinds from the trade war with the US, but at the same time, the fiscal boost that we'd seen for this year announced in this year's budget, a fair bit of it has already come through. So we're going to see less substantial fiscal support over the second half of the year. So that's going to be dragging on domestic demand. And then again, these continued external headwinds as well. So our general outlook is pretty downbeat, continued deflationary forces, slowing growth, and that's kind of the outlook for the rest of the year and into the years beyond as well.
Looking further ahead, I mean, you just talked about what this could all signify. These aren't major programs, but they could be suggestive of something more fundamental. There have been calls from without, but also from within the Chinese government for years about the need to boost consumption, to get money to households, to rebalance the economy. To the extent that there has been this internal debate within the government about what's been needed to boost the economy, to fix the economy, does this suggest that that debate is now leading to a clear outcome? That special action plan that they announced back in March on consumption actually does point to a shift in policy that will build on these programs, or is this just another false dawn?
Yeah, as you say, I think that's kind of the most important, interesting part of all of this. I mean, we often get asked by clients, why isn't China doing more? Why aren't they giving more to households? It seems kind of like an obvious answer to the problems that they're facing. I think there's a few important points to make on that front. First of all, it's kind of a broader cultural, historical point, really. Historically, the leadership has had a really strong aversion to any sort of kind of welfareism or borrowing to fund consumption. They're of the view that if you're going to borrow, it should go into investment because that'll pay in the future, and you're not kind of borrowing from future generations. Whereas borrowing to fund consumption feels like prioritizing the now, particularly in a country where expanding production has been the long run aim for its entire history, really. But this shift in approach to consumption boosting policies could be at least some sign that mindset shift is starting to happen. I mean, I'd caution against saying that this is, a complete shift in the leadership's attitude overall, but I think we do have to look out for these small mindset shifts, particularly when you're looking at things like the loan subsidy scheme. That's directly the government funding borrowing to fuel consumption. So that is a pretty substantial mindset shift in comparison to what we've seen from the Chinese government historically. And, things like the childcare subsidies, free kindergarten, that sets the groundwork for future policies of a similar ilk. Childcare subsidies can be expanded in the future. And again, with all these policies that we haven't seen before, they are an interesting sign, at least, that maybe the state of the economy is making it clear to the leadership internally, at least, that this is a shift that has to happen. As you say, it's something that kind of domestic economists in China have been flagging for some time. At the same time, it's a pretty big and entrenched problem that they're facing.
Yeah, talk about this idea that it is big, it is entrenched, because a lot of it feeds into China's demographic problems. This idea that paying households to have more children to try and turn around what is a fairly ugly demographic picture, and what that says about the country's long-term economic potential. But also, actually, it speaks as well, doesn't it, to the government's attempts to try to reinforce the social safety net as part of this effort to drive consumption. What have we learned about that?
Yeah, so on your first point, demographics are clearly a significant issue in China, and that's part of this aversion to increasing welfare spending as well. When you've got an aging population, that kind of is an eternal fiscal commitment that China's government probably doesn't want to be staring down the barrel of. So in some senses, it's easier to come up with, childcare subsidies, free kindergarten, and that kind of approach. It's hopefully boosting fertility rates is the plan, while also giving families more money to spend. But if we look at other countries that have put in similar policies, Japan, Korea come to mind, these policies haven't driven much of a demographic shift at all. So looking at the childcare subsidy proposal, for instance, I think the total benefits that China will be providing for each child throughout their lifetime comes up to about 7% of average annual household disposable income. Right now, that's in contrast to around 40% in Japan and even higher in Korea. And as I'm sure everyone is aware, Japan's fertility rate is still falling. Korea has the lowest fertility rate in the world. So yeah, when we're looking at the longer run demographic picture in China, it's still not looking very positive. And it seems quite unlikely that these policies are going to turn anything around. And as you say, with the broader social safety net for a communist country, you'd be surprised at how small China's social safety net is, really. And that's kind of a big part of what underpins the sky-high savings rate in China, which again goes back into why consumers aren't spending more. Families feel that they need to save for retirement, they need to save for all sorts of eventualities that the government may not provide for them. And there's been kind of a recent crackdown by the government trying to make sure that companies are paying their social security contributions. But again, this is going to hurt companies that are already struggling with really narrow margins, potentially lead to even further worsening labor market conditions. So yeah, it's a difficult position for the government to be in. On the one hand, it's trying to boost consumption, give families more money, increase spending, but at the same time, every policy that goes towards its aims of boosting consumption at the same time adds to the fiscal drag on the government and also the burdens facing companies that are already struggling. So it'll be interesting to see what happens from here. But it's easy to say that just more consumption boosting policies are all that matters, but it's a broader problem than that, really.
Leah Fahy there on Chinese consumption and the pain of belated rebalancing. I will add some recent analysis from Leah and the team to the podcast notes. As we've discussed at length on this podcast, as the economists have explained at length in their written analysis, this is a Chinese story, but with very global implications. It feeds into this idea that the global economy is dangerously imbalanced. And I'll add a note that Neil recently did, looking at this question of Chinese overcapacity, what's driving that, and the need for the government to boost consumption and how it fits into a geopolitical context. China is going to be a big part of these in-person briefings that the team is holding in September and October around the world, starting with Singapore on the 3rd of September and Hong Kong on the 4th. The briefings are all about how the breakdown in US-China relations are remaking the global order, and they're designed to update you on this economic fracturing process as we approach the second year of the second Trump administration. Leah and I were speaking just after 9 o'clock Friday morning London time. That's 2 o'clock in the morning in Wyoming. We are just hours from Jerome Powell's remarks at the Fed's annual offsite in Jackson Hole. Look out for our US and our markets team's analysis of his comments and their implications for stocks, bonds, and FX. And I'll add them to the notes of this podcast when they come. Now, what Powell said is going to have been influenced by that July US employment report. That jobs data shattered the relative summer calm in markets when it was released at the start of this month. It showed jobs growth plunging, and more worrying, it showed revisions to May and June jobs suggested that the US labor market was moving, in the words of Fed Governor Chris Waller, at near stall speed. We all know what happened next, including the fate of the head of the agency responsible for publishing that data. But from a global macro perspective, what's important to note is that the US is very much not alone. Our global economics team has been on the case advising clients that the slowdown in US jobs is part of a bigger story that's happening worldwide. And here's Jennifer McKeown, our chief global economist, on what's going on with employment across developed markets.
Well, it's certainly not specific to the US. We have seen signs of softening labour markets across the advanced economies. And actually, for some time now, really, since the peak in labour shortages that we saw during the pandemic, generally speaking, vacancy rates have been coming down, and employment has been falling in some cases as well. In both Germany and France, we've seen outright falls in employment over recent months, and also in the UK, in that case, payroll employment has fallen in 8 of the 9 months since the hikes in payroll taxes and the minimum wage were announced last October. In Canada too, we've seen a marked slowdown in employment this year. So this is very much a broad-based trend of labour market softening.
You mentioned the pandemic, and the dominant theme actually for labour markets in recent years have been that they've been unusually tight, and the pandemic has been a big reason for that. So to what extent is what we're seeing at the moment just a sort of reversion to those pre-pandemic conditions?
Yeah, I think that's certainly playing an important role here. We've seen, for example, the vacancy rate is now back down on average across the G7 economies. It's now back down to where it was just before the pandemic and at a more normal level before we saw those labour shortages pick up. So I think that is certainly part of what's at play here. Of course, it is the case that global demand generally has been softening. There is something of an underlying slowdown going on in labour markets. It's not that surprising, for example, that while we've seen global industrial production barely growing, that firms are now starting to cut back on employment to some extent. But I think it was really never any surprise that those kind of pandemic, extremely tight conditions weren't going to persist indefinitely.
This all sounds fairly benign, this process. Obviously, it's not if you can't find a job or if you're getting a notification to come in and speak to HR. But generally, what you're describing does sound like a fairly benign reversion to that pre-pandemic state. But are there markets where we're perhaps seeing something more than that, something slightly more worrying in terms of how the jobs picture is changing?
Yes, I think so far it is relatively benign. I can't think of any economies where we're seeing labour markets collapsing. And while unemployment rates have started to edge up, that is what they're doing, edging up rather than surging anywhere. Germany has seen some relatively sharp falls in employment, which look quite worrying on the face of it. And that partly reflects the ongoing weakness in German industry. It's still suffering from a long hangover from the sharp rise in energy prices that we saw a couple of years ago. And there are major structural headwinds facing German industry as well, which are meaning that further job cuts are likely.
Where does that leave the ECB? But talk more generally about how attuned central banks are to these signs of weakness. We're speaking a day after we had the minutes of the Fed's July meeting, and those minutes suggested that FOMC board members were overwhelmingly concerned about inflation rather than what was happening to the jobs market. But then that meeting happened before we had that grim unemployment report for July. The focus has shifted, perhaps. So with all that being said, I mean, how does that reflect what's happening across central banks, across monetary authorities?
Yeah, exactly. I'm sure the focus at the Fed will have very much shifted, and we're likely to see some more balanced rhetoric than we saw in the minutes at the next meeting and indeed at Jackson Hole. I think for central banks more generally, that they're facing this same dilemma between weakness in the labour market and still sticky inflation, less so in the Eurozone where inflation's now at target. The ECB can afford to be a bit less concerned about inflation and about wage growth. But in the UK's case, I think inflation is still a major concern, and also wage growth is still a major concern. Although we're seeing this clear softness in the labour market, we've seen employment falling, we've seen the unemployment rate edging up, wage growth is still really very high in the UK. So that's going to be a lingering concern for the Bank of England, which I think will mean that interest rate cuts are relatively gradual in the near term, but they are likely to pick up pace next year. And that's largely due to this broader weakening in the labour market that we're seeing. If we look across a variety of indicators, which point very firmly to a sharp slowdown in wage growth in the UK in the months to come.
I'm glad you said variety of indicators, because obviously one key question at the moment is the reliability of labour market data. What can you say to that? How accurate a picture do we have of what's happening in these markets?
Yeah, well, it's very difficult to judge. And of course, there's been a lot of attention on the BLS and on the US statistics. But in fact, things are probably even worse in the UK, where we've had persistent issues around survey response rates and data reliability for the labour market for quite some time now. We have tackled that by looking across a whole variety of indicators. We don't need to rely solely on the labour force survey. We have lots of other surveys, such as the scores of recruitment difficulties from the Bank of England's agents. We have measures of redundancies. We have the claimant count unemployment rate, and we can look at the vacancy rate as well to give a broader indication of underlying conditions in the labour market. What we've done at Capital Economics is to put all of those things together in a model to give us our own measures of both employment and unemployment. And what they suggest actually is that things are worse than the headline figures would suggest, and that the unemployment rate is picking up more sharply. And that's one of the things that gives us confidence that wage growth will come down over the next year. And as well as concerns about the quality of the data, the reliability of the data, which have been raised across advanced economies, we need to think about the interpretation of those data and what we need to read from them. In the US, for example, the fact that payrolls employment growth has slowed very sharply is not so surprising, given the fact that the labour supply has slowed significantly. We've had these major cutbacks in immigration in the US, which have meant that the pool of labour has shrunk. And it's no surprise, really, that that means that payroll employment isn't growing as quickly as it was. And I think that that's something that we need to get used to. These kinds of gains of around the 50,000 mark are probably a sign of things to come. And importantly, from the Fed's perspective, they won't necessarily cause the unemployment rate to pick up, because we've got labour supply dwindling at the same time. And that means that the implications for inflation are much less than they would otherwise be. Again, for the US, we've taken a lot of these different indicators together and put them all in one place in our US labour market dashboard on our website, which looks across things like not just employment and unemployment, but also the labour supply, what's happening to immigration, and what's happening to earnings and so on.
Because of Trump's policies, there's structural changes happening within the US labour market. And that kind of brings me to this idea that although we've been talking about this reversion to the pre-pandemic norm or pre-pandemic conditions, are there risks that we may be on the cusp of seeing a bigger shakeout? And just to throw one factor at you, I mean, not a day goes by when we don't see headlines about the devastating impact that AI could have on labour markets, and the companies talking about building these efficiencies into their operations that allow them then to shrink payroll. So what are the downside risks here?
So far as the US is concerned, I think there's little evidence really to suggest that we're on the cusp of a major shakeout. As I said, a lot of the slowdown in payrolls growth is about the slowdown in the labour supply and the reduction in immigration, rather than a big pickup in layoffs. I think I'm somewhat more concerned about the UK. There we've seen a more abrupt downturn in vacancies and in some of the survey indicators of labour market conditions. And with wage growth still very sticky, given the rise in the minimum wage that we've seen, also the rise in employers' taxes. I think that there is a bigger risk in the UK that employers respond to this with bigger layoffs. And indeed, in the employment intentions surveys, for example, for the UK, we are seeing some worrying signs. So I think if I were to point to one area where there is a risk of a bigger shakeout, it's probably the UK. Now, admittedly, in the UK's case, we did see a pickup in the employment index of the PMI survey in data that have just been released for August. And that's somewhat encouraging. But really, what that survey is pointing to now is sort of a possibility that we're past the worst rather than any signs of significant improvement in the UK labour market. Now, it's true that a number of AI-linked redundancies have hit the headlines recently, and that's no surprise. This is interesting stuff. These are major changes across advanced economies and the global economy more generally, and there are fears that this might cause a surge in unemployment. But actually, we think that fears of a big long-term rise in technological unemployment are probably misplaced. In fact, in a lot of cases, AI is complementing labour and improving its efficiency rather than necessarily replacing it. And that's one of the reasons why we expect AI to cause a big pickup in productivity growth in the years ahead. Now, that's not to say that there will be no job losses through AI, but those that we've seen have been largely concentrated in sectors such as software, where perhaps there were big increases in employment during the pandemic and around that time. And some of those jobs are now being replaced by AI. But we think that on aggregate, probably fears are overdone. And also that the focus on this exposure of jobs to automation neglects the potential positive effects of AI that could boost the global economy.
Jennifer McKeown there on DM labour markets. I will add the team's analysis to the podcast notes as well as links to those data tools that Jenny mentioned. So that's our UK labour market indicators, which now have an unemployment proxy that measures labour market slack, and the US labour market dashboard, which is basically an interactive guide to the jobs measures that the Fed is watching as officials there try to calibrate monetary policy. Jenny touched on AI's impact at the end of our chat. There has been an AI backlash going on these past few weeks. Stocks are down. There's lots of commentary that this is all hype. What's going on may well be part of the hype cycle that our team addressed in their 2023 project, all about AI, and why we think, despite the naysayers, that this technology will be transformative for economies. I will add a link to that project to the podcast notes too. But that's it for this week. Until next time, goodbye.